I'm Jack Farley, stepping in for Mike. Really happy to have, as always, Mark Yusko, CIO of Morgan Creep Asset Management, on the margin. Great to have you, Mark. How you doing?
No, Jack, thanks for filling in while Mike's off playing in Morocco, and we'll start off the same way. We'll do the soccer wheel, and Mike hates when I do this. I get up on the desk, I got my Bitcoin Friday pants on, and I am willing the market into a bull market. I got the Bitcoin bull socks on today.
Nice.
And we're gonna get this thing started. We're still in crypto spring, so it's not gonna be a big bull market, but that's where we are. And then I do have the Keep Calm, We'll Print More shirt on, so we can talk macro.
Oh, well, okay, Mark, you're really queuing me up. I mean, I feel like we can talk 2 hours about that shirt. By the way, I want to give a shout out to your pants. Very seasonal, very autumnal. I actually, I'm a little biased. I have pants of a very similar color myself, and it's just a great time to wear them.
It is, and look, black and orange. It's a little early for Halloween, but it just is what it is.
Well, Mark, things are spooky already in markets. We may not be at Halloween yet.
I like it.
Mark, I want to talk about whether the Bank of England is that as sort of a harbinger for the printing that will come based on your shirt. But because it just came out about 40 minutes ago, let's talk about this labor market report where the unemployment rate actually declined back down to 3.5%. And the whole idea is when you have a softening of labor market conditions, i.e. unemployment goes up, that is essentially disinflationary, will bring deflation down. So, Jay Powell is never going to say we want fewer people to be employed, but they do want a softening of labor market conditions. So, does this put upward pressure on the Federal Reserve to remain tight? And if so, do you think that's a mistake? What do you think?
Oh, wow. I mean, so many important questions. And, we talk about this a lot, that answers are cheap, right? Having answers or facts, easy. What's really hard is to formulate the important questions. It's one thing I appreciate about you and Mike and the other guys at Blockworks that do this. It's spending the time to actually come up with the right questions. And so the key question there is, does this number, right? Does this trend in jobs give them backup for their current path, right? This tightening path they've been on, which I will say, right? I believe this is the third worst policy decision in the last 200 years. Big statement. So, when we were at DAS, again, great Blockworks event, we're at DAS and we're finishing up, and Mike said, so, guys, I was on the panel with Dan and Bill, and he said, give me just your thoughts on the next few months. I'm like, well, here's the problem. In 1840, and DTAP turns to me, Dan Tapiero says, Mark, he asked for like a summary, and you're going back to 1840? I'm like, right. No, it's really important to understand that the worst policy error that banks, because there was no Fed in 1840. In fact, there was no national bank. They had not renewed the second national bank charter, so we were in the era of free banking. And basically what happened is we had a garden variety recession, and these banks, because they were all issuing their own money and nobody wanted their money to go down in value. And then a whole bunch of stuff was happening in the railroads and all this stuff. But bottom line is they all tightened liquidity and turned a garden variety recession into what was the time the worst depression the young country had ever seen. So fast forward 90 years to 1930, and the second worst policy error made by then the Fed. So the Fed started in 1913, the creature from Jekyll Island. And here's the thing. So the market crashed, and instead of doing what they should have done, Congress, the two dumbest guys in Congress. Now that's a big statement because it's like an oxymoron, right? Dumb Congress. I mean, I shouldn't say that, but Smoot and Hawley, these two guys passed tariffs, right? Deglobalized, lowered trade, and terrible decision. But then the Fed raised rates into this recession, which then turned into the Great Depression. So now 90 years later, and why is it always 90 years, Jack? Well, it's because it takes a full generation to forget and get stupid again. So here we are, again, with a downward spiral in global economic activity, right? Populism, nationalism, deglobalization, COVID lockdowns, Russian problems, all this stuff. And what does the Fed do? They tighten? Come on. And it's just one of these things where, okay, what's the idea? Does he really believe that's what you have to do? So one theory is, well, you got to reload the gun, right? You should have reloaded the gun in 2013. You didn't. What I mean by reload the gun, you need to raise rates so you can lower them again.
Right.
Like,
and Mark,
right.
do you think the Fed should have done that maybe a year ago or 18 months ago in early 2021?
Oh, for sure. But they should have started in 2013. By 2013, QE had us back on track. We were growing. Why did we keep emergency interest rates for 10 years? Well, it's because, do you borrow at Fed funds? I don't borrow at Fed funds.
I don't. I want to, though.
The banks, right?
Yeah.
So the banks were still in jeopardy. They still had too little capital, too much leverage, and we were recapitalizing the banking system by lending them money at zero and letting them invest in treasuries at risk-free 2 or 3%. My favorite stat, JP Morgan, 0 trading days that were negative in the last 3 to 4 years. That's not possible. You can't win every day. Well, if you're not taking any risk, you can.
Right.
So all this goes back to this idea that they should have raised rates, but they didn't. Okay, so now he thinks, well, I got to get the gun reloaded because we're going to have a doozy of a downturn. I'm going to have to cut rates.
Right.
Like, okay, but here's the problem, Jay. How many interest rate hikes, or Jerome the hawk is back, right? He started as Jerome. He was a hawk, and then Trump beat him down to Jay, the dove, plucked all his feathers. Then he became Jay, the letter J with the hoodie, the pusher, like handing out stimmy checks to everybody.
The printer meme, yeah.
Yeah, the printer meme, right? Printer go burr. I mean, he was just Jay the printer. And so then he went back to Jay, J-A-Y, the dove. Well, now he's turned back into Jerome, the hawk. And so Jerome is being hawkish. Well, why? Well, I think he really does believe he's going to need the bullets. But here's the problem. How many interest rate hikes, Jerome, will it take to fix the zero COVID policy lockdown effects on supply chain? Doesn't matter what you do. That's not going to fix it. How many interest rate hikes are going to change the price of wheat in Ukraine? None. Zero. Not going to happen. Not going to help. How many interest rate hikes are going to change the price of gas to Europe? I mean, we could blow up the pipeline. Okay, fine. And probably did that. But his interest rate hikes aren't going to matter. So what is it doing? So there's only 2 things it could be. One, he's just forgot the stupidity of the previous 90-year cycles, and he's just going to go down in history as the third dumbest. Or it's sinister. So we always talk about Sinister Saturday because this comes out on Saturday morning.
Yep.
And I always say the sinister view was, well, this is all part of the plan, right? When you are an aging empire, you've replaced capitalism with cronyism. So you got all your friends at the tippy top of the pyramid, and you channel all the assets up to those people, right? The average person doesn't own anything, right? They don't own a house because you can't afford to buy a house. They don't own their car, right? The average car payment now is $700. The average loan is creeping up on 7 years. You don't own that car, you're renting it. So no one owns anything. So all the ownership is up here. And then what do? You basically devalue the currency and make the top people rich and the bottom people poor. Well, what's another way to make people poor? Well, put them in a recession or depression. Okay, so is this intentional? Is like this part of the dictator playbook? Well, here's the funny thing. The dictator playbook goes like this. You do that, you put everything at the top, you crush everything, turn your economy into dog poop, like what they did in Venezuela, right?
Technical term, as an economic term, dog poop, yeah.
Yeah, dog poop, yeah. And then what do? Right? You get super rich, the masses get poor, but then I always wondered, how do these people stay in power? Oh, you give people free stuff. If you're in Argentina, you give them free electricity. If you're in Venezuela, you give them literally free money. Here, what are we doing? Forgiving student debt. Now we just yesterday, Gavin Newsom saying, hey, we're sending you $1,000 check. That is to buy votes. That's what that is.
Yes.
And so the whole thing is freaky to me. Anyway, it's a long answer.
That's a great answer. You've given me a lot to work with, Mark. I think part of the reason why the 1929-1930 Federal Reserve decision to hike interest rates was so disastrous was it's not as if they plunged the global economy into a recession in order to tame inflation. Inflation was basically zero in 1929. Right. So they didn't even have an excuse. So now that inflation, was it 9%, 8.5%? We can all agree it's high, and you're absolutely right that a lot of it is supply side driven, i.e., not interest rate sensitive. So the price of natural gas is not necessarily going to respond, even if the Fed funds rate goes to 10%. But doesn't the Federal Reserve have to go through the motions? And you've seen that chart. It's an easy chart to make of spot inflation, so 8.5%, and spot Fed funds, which is 3%. Inflation's still twice as high, almost 3 times as high as rates. So just looking at that simple chart, it looks like, money is almost, the inflation is being deflated away almost twice as fast as the price of money.
Such an important point. But here's the problem. Measurement, numbers. Government numbers are a sham. They're a total sham, right? CPI has been a sham for 3 decades. You go to this guy, shadowstats.com, and you look at how he does CPI based on the actual calculation, how it used to be. So they move things around. So we had the Volcker problem, right? Where CPI was double counting inflation. So everyone says Volcker was such a genius. No, Volcker actually caused the problem that then he fixed. It's like the arsonist calling the fire department.
How did he cause the problem? By making real estate more expensive from mortgage rates?
Yeah, what happened is the CPI was counting housing prices in the thing. So in the measurement, and it was counting interest rates. So as he raised interest rates, he raised the actual CPI, which then he saw, which then compounded the price increases of stuff, which then went back into CPI. And so you had this feedback mechanism that made it go all the way to 21% before it choked up, because it happened really fast because of bad counting. And so then, quote unquote, he breaks the back of inflation. Okay, whatever. Inflation happens when there's too many young people in an economy. That's when inflation happens, right? When you have a lot of 25 to 45-year-olds, you get inflation. Look around the world where there's high inflation, you'll find a lot of 25 to 45-year-olds. Now, why is that? It's because 25 to 45-year-olds, as nice as they are not really very productive, right? They're learning their jobs, and some are really entrepreneurial or whatever, but on average, they're learning how to work, and prices and companies borrow from their customers in the form of higher prices for training those workers.
And they like to, they buy houses, whereas the average, 70-year-old is not buying a new home and buying, a baby crib, right, for example. Yeah.
And to your point, the flip side is the average 65 to 85-year-old, not productive at all, perfectly nice people. And the problem with the US, Europe, and Japan, the reason we're in deflation, the reason we have, very low interest rates, very low inflation, which we'll come back to, actual inflation, is that those people don't buy anything, right? They don't spend a lot of money. They save money. They buy bonds. And so it's when you're 45 to 65 that things are rocking, and you get disinflation and you get fast growth. And so what was happening in the 70s is the baby boomers were coming of age. And then it wasn't until the 80s and 90s and into the 2000s when we had our boom period, because demographically it was good. So if you look around the world, Japan is 11 years ahead of us. Europe's 9 years ahead of us. 2 years ahead of us, 9 years behind Japan. We're 11 years behind Japan. So whatever happened in Japan is going to happen 11 years later in the United States. So if you look at the peak in the market in Japan, 1989, 11 years later, 2000, we had a market crash, market peak, the tech bubble. Same thing happens when debt downgrade, 11 years later, US debt gets downgraded. So my point here is that CPI is mismeasured because in CPI, you have something called owner's equivalent rent, which is the rent you charge yourself to rent your house from yourself, which you would never raise.
Right.
Housing prices, right? I'm sitting in this house in Chapel Hill, North Carolina, which Zillow tells me went up 40% in the last 12 months. Nope. Did my house grow? Did my house get more productive? Did it get more efficient? No, it actually wore out. I had to put money into it. But what happened? It didn't go up. The currency I price it in went down. And that's my subtle thing about inflation versus money devaluation.
Right. Okay. So, Mark, let me explain that for the audience. It's a it's kind of high level point. So, yeah, in the 1980s, if your house went up in value, some percentage of that would actually be captured in the CPI report. But the way that consumer price inflation was measured has changed, and now it's like, oh, that's an asset. Like, Mark, if you own Tesla, which I know is one of your favorite stocks, you own Tesla, it went from $100 to $1,000. You are wealthier, but that's not the same thing. That's an asset. It's not the same thing as if the food went up 900%, right? So they're saying, let's actually talk about shelter as a cost, rent. So shelter is about a third of CPI. Some fraction of that is rent, which is what people who don't own homes and who rent pay. But then there's owner equivalent rent, which is a OER. You mentioned it. It's a pretty abstract, let's put it that way, concept, which is you go around, you ask people, how much do you think you would be able to rent this out? And Jeffrey Gundlach has made the point that's kind of a silly point because even real estate experts, people who work in real estate, they don't know how much you can rent their house. It's entirely hypothetical. You'd have to go block by block and take a survey of thousands of people and actually see if you can put it on the market. And then there's a counting issue of they put people into 6 different groups, so it's always delayed. So so OER. So I agree that it's my opinion that I agree with you that CPI is flawed to the downside. But if it's flawed to the downside, isn't inflation actually higher than 8%?
Yes. Excellent point again. But here's my argument that all of the increase, I will argue, over the past 12 months. And remember, CPI is a lagging indicator. It's like the proverbial pig in the python. It just takes a long time to get through. And so basically what happened is we make the dumbest policy decisions in the history of mankind. Big statement, I'm prone to hyperbole, but I believe this, right?
Is this too loose in 2021 or too tight in 2022?
The lockdowns.
Okay, yeah.
Policy. So not economic policy, not Fed policy. The lockdowns. Okay, to take a flu virus and to lock people in their apartments and shut down the global supply chain will go down in history as the dumbest decision in the history of decisions, right? I mean, I feel like I'm at Capital One commercial. Just a bad decision. So, but that said, what did it do? Well, it caused a massive disruption in oil. Oil went to negative prices in April of 2020. Negative $39. Okay. So then it got back to zero, and then it got back to like 40 and stabilized at 40. Okay. Then it goes to 120. Well, how did that happen? Well, Saudi, during the crisis, sent tankers full of oil to Houston, to the ship channel, and filled up all the storage. So no one could take their oil from West Texas and put it in storage. So literally drowning in oil. Yeah. They have nowhere to put it. They have to pay people to take it away.
The price of storage was more expensive than the oil itself. So net, it's physical oil is negative. It was negative.
Exactly. Yeah. So then what did Saudi do? They went out and bought. So what happened? All the prices of oil companies went down 75, 85, 90%. And Saudi, which has a lot of money in the sovereign wealth fund, went out and bought them. Genius. I mean, mad genius. Manipulating markets? Yes. Illegal? I guess not. But they did that. So then what do? I'm like, well, now I'm going to cut supply. Oil will soar, right? Because we're going to unlock people and they'll have some more demand and we're going to control it. And oil tripled. And then what happened? Well, because of the lockdowns, you couldn't get stuff, mostly cars or chips. And so used car prices went crazy. I mean, literally, used cars were selling for more than new cars. And we had this weird anomaly that if you take those two numbers, it's 75, 80% of the CPI delta. Well, both of those are now going to go away.
Yes.
Literally going to go back to zero. In fact, might even go negative. I've made the argument that by the election, so we only got 4 weeks left, I said oil would be $60 and gas would be sub $3 because it's the only chance the Democrats have to win anything. I mean, otherwise they're just going to get absolutely trashed. But I think Saudi is fighting them, right? I mean,
they
Saudi
are, and Mark, I can help you out there. So this is today's New York Times. Biden to Saudis and Russia agree to oil cuts in jab at the West. Saudi and Russia, OPEC Plus, agreed on Wednesday to their first production cut in more than 2 years in a bid to raise prices, a cut of 2 million barrels. Quote, the White House was not happy. And this is a quote. The president is disappointed by the short-sighted decision by OPEC Plus to cut production quotas while the global economy is dealing with the continued negative impact of Putin's invasion of Ukraine. Yeah. So but that's 2% of the global supply that's going to be offline. And yes, the current production is not at the quotas now, so it's going to be less. But so even does this change your outlook? This production cut of $60 oil?
It does. Okay, and look, it absolutely does. And here's the thing. I'm heading to Vegas on Sunday for a big Web3 thing, and I tell the story that my wife's only seen me speak one time. She came to Vegas for a conference a couple of years ago. And at the end, I mean, she was in the back with my son. And she comes up, she says, Mark, you can't say things like that. I'm like, what would I say? She says, no, you say everything so forcefully. I said, well, what's wrong with that? She says, well, people will believe you. I'm like, well, that's the whole idea. She says, well, what if you're wrong? I said, I'm wrong all the time. I just changed my mind. Yeah. I mean, this idea, I hate when people troll on Twitter. They're like, 4 years ago, you said, I'm like, dude, I have changed my mind 11 times in 4 years. It's okay. When the facts change, I change my mind.
But that's 11 times isn't that many. Like if you asked me a year ago, like are bonds a good investment, with the 10-year at 1%, I probably would have said no. But now, 2-year treasury yields are getting 4.2%. Ray Dalio is saying cash isn't trash. I kind of agree with him. I don't know.
Absolutely. Long bonds in particular, right?
Yeah.
Because again, I think deflation is coming. And we'll come back to the jobs number. If you look at working age population growth, it is trending to zero. Right? We're not replacing ourselves. Our birth rate is sub 2.1, so we're not replacing ourselves. So we have negative demographics. Every day, 10,000 people turn 65 and they retire, according to BLS. Now, this is the part about the jobs number that's so stupid, right? Every day, 10,000 people turn 65 and they take them out of the labor force. Have you been to a Walmart? Most of the people in there that working are over 65. Not everybody, but I mean, that's just a dumb rule. And the idea that is literally a rule it's again, the second dumbest BLS rule. The other thing goes to this idea of the birth-death ratio. And this just pisses me off because about 70 odd percent, whatever the number is, 73, 75, doesn't really matter. 70 some odd percent of the jobs that were created this year are fake.
You're talking about JOLTS, like the job openings. You think they're...
Well, no. The actual jobs that they report, that the BLS, because here's what they do.
Oh.
They don't actually count the jobs. I'm like, well, why not? I mean, we actually have electronic means to do that. In fact, we have taxes, payroll taxes. So we could tell exactly how many jobs. Well, we couldn't tell the underground jobs, cash payment jobs, like my barber and stuff like that. Mm-hmm. But okay, but we should be able to count it. Oh, no. We use a methodology that goes something like this. We are X months into an expansion. Well, actually, the expansion's over. We're in a recession, but that's
palpably true. Like the PMIs, a PMI below 50 means contraction. PMI has been below 50 for months. Yeah,
exactly. And so, but because we haven't called it, we're in an expansion, and therefore, this many months of expansion, this many companies form, this many companies die, birth, death. Therefore, this many jobs were created.
Oh, I didn't know that.
Oh no, Jack! You got to dig into this. Dig into the birth-death ratio. It is the dumbest way to calculate. Again, in an age where we got satellite images of me walking out to get the paper. I can't walk out to get the paper anymore, but walk out with the dog. I mean, we know exactly what's happening, but we refuse to acknowledge it because we want the numbers to be a certain way. So they want cover to continue to raise rates. So you just manufacture a higher jobs number. But the reality is every company I know, including my own, right? And I don't like to admit this, but we are having to do a little kind of fine tuning, shall we say.
Right.
Not mass layoffs or anything, but it's real.
A lot of companies are. You see, headlines from Facebook saying they're going to be a smaller company and by the end of this year than at the beginning of this year.
Yeah, hiring freeze, same thing. We're in that same camp, and it's just the world is changed. So there's that part of it, and then there's the JOLTS thing.
Yeah,
and the JOLTS thing just pisses me off.
That's the number of job openings.
Yeah, because in the old days, a job opening was an ad in a newspaper, and there was one newspaper, and you did one ad. Well, now in remote work and digital, I got a job opening. I put it in 50 different states, and they count them as job openings.
Right. I think that's such a good point, Mark. And it took me a while to really just understand how significant that is, because back in the day, to have a job opening, you have to pay the newspaper. It really cost you, a marginal amount of money. Whereas now it's just you go to Indeed.com and what you get you pay 1 penny per view, look, if that. So
I'm just learning how to use LinkedIn.
Me too.
I'm just learning, and every day it pops up, and I don't even know how to get rid of it. Want to advertise a free job? Want to advertise a job for free? I'm like, no, I want to figure out how I connect with the people who want to connect with me. I haven't even figured out that button yet. So, which again, just show my boomerism and tech. But
you have an excuse. I'm young. I'm figuring out LinkedIn too. It's tough.
Yeah, but I don't know. We're in this funky place that it's a probability distribution. Soros says that you should never think about markets as absolutes, that you can know what's going to happen, because that's silly, right? It's folly. So you should think about probability distributions and scenarios. He likes to call it scenarios. So let's do the scenarios. So a month from now, the Fed is either going to do what they say they were going to do, 75 basis points. Okay. I'm going to give that a medium grade probability. Okay. 100 basis points. He does more. I'm going to give that a really small. Not zero.
I would agree with you. Yeah.
Yeah. But not zero, but really low. He's going to do 50. I'm going to say that's probably equivalent to the 75, probably. 25. Not zero, but low. He's going to cut. Close to zero.
Yeah, nothing's ever zero. Yeah.
Not zero, but as close to zero as you. So that's a probability distribution. Now we got a probability weighted. Is it 0? Is it 2%, 0.1%, 30%, 40%?
Right.
Okay. Now we can do that. Now we can say, okay, what's going to happen? And this is where I talk about the face melter. I've been talking about this lately. The face melter rally. And we got a hint of that on Monday, Tuesday, which
we did.
If he positively surprises, meaning raises by less or
by 50.
Doesn't raise at all.
Yeah.
The short covering rally will be a screamer. And I think that's part of the plan, right? Which is, if you can't fix the economics, right, you're not going to change the fact that earnings this quarter and next quarter and probably first quarter next year are gonna, technical terms, suck. AMD announced last night was not good. And Mike, I love Microsoft. I don't know if you remember this. Microsoft when they announced second quarter earnings in the summer, they're like, yeah, we were flat, but by fourth quarter we're gonna be back to 12%. And the market took. The stock took off like 5%. I'm like, are you kidding me? You can't. That is stock manipulation. That is a false statement. There is zero chance that Microsoft sales, in a world where AMD tells us that PC unit sales are falling, that you're going to go back to 12% growth. And but no one calls people out on this. And then the other thing that drives me, this again, personal pet peeve. I call it the high jump champion thing. Okay. You walk up to the high jump bar.
Right.
Take the bar off the rack. You put it on the ground.
Oh my God. Yeah.
Jump over it, and you claim you're the high jump champion.
Right.
So what happens is, a year ago, company A, pick a company, said, I'm going to make $1, Jack. I'm going to make $1 this quarter. 6 months ago, they're like, well, I'm going to make 50 cents. Last week, they said, I'm going to make a dime. And then they report 11 cents. And everybody's like, oh, it's a beat.
Yeah, exactly.
Are you joking?
Mark, my electric vehicle company deliveries are up 100% year over year. Last year I delivered one electric vehicle, and this year I delivered two. You want to invest? Let's do a deal.
That sounds like Rivian.
Yeah.
I think there's one Rivian truck in the whole country, and it's here in Chapel Hill, and I see it every now and then. He drives like really slowly. I'm like, dude, what are you doing?
Yeah, Mark, I want to ask you about earnings, but just because you said Rivian, I gotta pull up this chart. I think it was actually Michael Burry on Twitter who deletes his tweets almost immediately after he posts them. But he said there were many companies that had huge market caps over $10 billion with negative EBITDA earnings or even EBITDA below $1 million. So companies like Snowflake, Uber. I said Snoober because I read Snowflake and Uber. Snowflake, Uber, Shopify, Square, Rivian, companies like these. Those companies, sort of unprofitable technology companies, growth stocks, richly valued companies. Those companies, as you know, have been the companies that have sold off the most this year. Do you think that will continue? Like, despite the fact that they're down 50%, they're still overvalued, or what do you see?
Look, now this is tough for me because if my son's actually watching, he's gonna be mad at me because he works for Snowflake, and so I want nothing but the best for my son. Thankfully, he sold a bunch of his shares, but not all. And but look, I mean, Snowflake is a great company. Don't get me wrong; it is a world-changing company, 100%. I mean, they have one competitor that's tough, but they are a world-changing company, and every business in the world will use their structure of separating data and compute. So, okay, but that doesn't change the fact that you can't sell for 100 times revenues.
Not profit, not revenue.
You just can't revenues. Yeah, not profit. Forget profit because they don't have any profit. But you can't sell. Now they did come down, Jack. I mean, they were at 220 times revenues. Now I think they're only at like 75.
Yeah.
So they're a bargain. And this is the thing that makes me crazy. People say, oh, Shopify, it's a bargain. Yeah. It's only selling at 6 times revenues. I'm like, are you kidding me? There are no companies in history that stay at 6 times revenues or 10 times or 75 times.
Especially if they don't make money. Like, Visa, they have a high price of sales because it's just such a good business. And if there's inflation, that's automatically counts into their profits, whatever. But, a company that's selling at 1/10 of revenues, that stock can be worth zero if it's not making money and the stock's bankrupt. It's
Look, the whole point of equity.
Yeah.
Right. This is, again, I'm gonna make the Tesla bulls mad. That's my job. Is Tesla owes more than they could ever create in dollars, right? Their debt exceeds their assets. Okay. So technically their equity is worthless, right? Oh, no.
I mean, I can look it up, but it exceeds their liquid assets. I mean, because there's lots of like goodwill and we own plant, but in terms of cash in the bank, I believe you. Yeah.
No, but my point is that what you could turn into liquid assets.
Sure. I'm no Tesla bull, by the way, but yeah.
Selling the goodwill is a little challenging, but here's the thing, and I stand by the statement: they will never make money selling cars. Not ever. Right? They'll sell their carbon credits and other stuff because he pays a lot of money to Congress to get that allowed. But we'll never make money selling cars. And here's the thing that I'm struggling with. If demand for EVs, I think he said the other day that China EV demand is off. I can't remember the term he used, but said, unlimited. If that were true, then why are all the EV stocks, particularly the Chinese ones, going down so much?
Very true. And China is going to be much more friendly to its own. I mean, look what China did to Google. There's no Google in China. They use Baidu. And Tesla, I think, Elon Musk has played very nice with the Chinese leadership and they've been treated nicely. But so I want to ask you about, China, you know this, when you ask what's the best time to invest in risk assets, frequently it's at the time when people are panicking the most and the economy is the deepest into recession. So, for example, March of 2009, fantastic time to buy stocks. That was when everyone was crazy. People in China, the stock market's really down. Yep. The economy suffered, its worst economic growth number, a negative number. I think since the last time, literally since Chairman Mao in the 1970s. Is this a good time to buy? Alibaba. I guess there's a lot of ETFs that have China, like a
100%. Buy K-Web hand over fist.
Okay.
I own it. Full disclosure. Look, you're exactly right. The greatest time to invest, period, and it's exaggeratedly so in emerging markets, is when things go from truly awful to merely bad. Right? That is bar none the best time to invest. But it's the hardest. And in order to do it, you need three things. You need conviction. Okay? And conviction comes from work, doing the work in advance. You need courage. That's just intestinal fortitude to have a discipline. And you need cash. Having all three at the right time is hard, right? There aren't that many people who are willing to sit on cash and wait for that fat pitch. Buffett says you don't have to swing. True.
Right.
And
because the people with the most intestinal fortitude had already bought the stuff with their cash. So they don't have any cash at the bottom. Yeah.
Well, and that's it's funny you say that. So I have this, I don't call him a buddy, right? But, we're friendly and we actually invested. So Mike Alfred, and Mike's all over Twitter. And so he was very bullish on, and again, Mike, I'm not criticizing at all because I agree with you. He was very bullish on the miners, the Bitcoin miners.
Yeah, right.
And he bought them, and he was very loud about it. And again, I like loud. I'm not, again, that's not a criticism. I'm loud.
Loud's not bad. Yeah.
Loud is good. And he's very loud about it. And then they went down. And somebody said, what do you think? He's like, I'm all in. And then they went down again. And someone said, so now what? He says, well, I'm all in. He said, well, you were all in last time. What do you do? Where'd you get the money? And I think that is part of the challenge is any of us who invest, right? We have to balance a couple things. One, we have to balance rebalancing. Right?
Yes.
Should you sell your winners and buy your losers? Okay. Rebalancing is good on some periodic basis. But more interestingly, what you really want to do is cut your losers fast and buy more of what's working. So do more of what's working, right? That's actually the key. Julian Robertson, God rest his soul, just passed away a month ago, one of my mentors, and just maybe the greatest investor of all time. And what I mean by that is not only was he a great investor in stuff, I mean, his long-term compound returns are off the charts, but his investment acumen at identifying talent, training talent, and backing talent, no one even close. There's no one in the same zip code. And so I would always ask people who were trained by him, what made Julian so special? I said two things. One, he always said, okay, live to fight another day. You're not right. The market's right. So when it's going against you, just get out of the way. Just live to fight another day. Go find another good idea. You got lots of good ideas. You're supposed to have lots of good ideas. And the second is they said he had an uncanny ability to double up.
Mm-hmm.
When something was working, he would press the accelerator. Because most people
and buy more.
Buy more.
Yeah.
And what Peter Lynch would talk about is most people do the opposite. Like to invest, well, you're supposed to pull your weeds and let your flowers grow.
Right.
Plant lots of flowers, but let them grow. Most people pull their flowers. As soon as you're up 10%, oh, I don't want to lose it. And then when something goes down, they're like, oh, I have to buy more because I'm right.
Yeah.
Maybe you're not right.
So like in 2010, if I bought, my portfolio was 50% Intel, or let's say 50% IBM and 50% Amazon. As Amazon went up and IBM floundered, the right thing to do is sell IBM and buy more Amazon. But actually, what most people do, and what I do, is you sell the Amazon and to buy more IBM. Yeah.
Yeah, I'm guilty. And look, we all know concentration makes you rich and diversification keeps you rich. So it depends. Are you in the get rich business, right? If you're young, you should be taking more risk, not less, right? You should be embracing volatility. You should be building bets in new tech. Like I always say all the time, if you're under 65, it should be against the law to own bonds. Right? You shouldn't own bonds, particularly under 45. I mean, literally, if you have 401k, zero in bonds. until you're 65, 70. Just zero. You should have it all in high growth, innovative stuff. So, but I guess the last thing that I think is interesting and on China. So there was an analyst that had worked for him, and he sent him over to China to do a bunch of research. And he went over and he met all these companies, spent 2 weeks, met all those companies, came back, and he had a list of 13. And Julian calls him in and says, okay, what do you got? And he hands him the list, and Julian's looking at it, and he starts talking and pitching his best idea of the 13. And Julian says, we're good. And he hits the speed dial and says, buy them. And the guy's like, well, I didn't make my pitch yet. He says, no, this is good. 13, I'll buy them all. And then the ones that go up, I'm going to buy more.
Yeah.
I'm like, genius, right? You had the great analyst go do the work to narrow the funnel to this is. And so the question is, should I buy Baba? Should I buy Tencent? No, buy KWeb because it owns, the top 10 or 15 or 20. And then the stuff that goes up, buy more. So that's what I would do at China.
That makes sense. So your shirt, do you want to show the audience your shirt again? Keep calm. Keep
we'll
calm
print more.
And print more. The Bank of England last week bailed out the British pension system, which was levered long duration bonds. Mark, you worked with Julian Robertson. You have a lot of experience in the hedge fund business, which is, basically about making as much money as possible. But then you also have experience working, with endowments, which is more about like long-term planning. And that is definitely where these British pension funds in particular are there doing something called liability-driven investment, where they're like, we have all these boomers who we have to pay pensions to. Basically, the boomers, we're short bonds. We're short the bonds, so we should be long bonds to match that thing. The problem is yields are so low, so they have to do all sorts of swaps and sort of wild things or things that are safe when interest rates are non-volatile, but when interest rates are volatile, the Bank of England has to step in. What are your thoughts there? And then also, is this a harbinger for what's something to come with other central banks?
Look, they all got sold a bill of goods. First by Ray Dalio et al., risk parity. And look, when rates are falling, risk parity is awesome. Levering long bonds into falling interest rates, awesome. But to your point, as interest rates go lower and lower, that starts to break down. It's kind of like the Fed model, right? Everybody says the Fed model. As long as when interest rates are low, you should have a higher PE and you should have more equities. I'm like, well, yeah, that's fine to about 2%. Below 2%, the reason interest rates are low is because economic growth sucks. And so equities are going to do worse. So you shouldn't be levering up into that. But that said, when you get to that lower bound, the whole model breaks down. So first they were sold the bill of goods by Bridgewater et al. And it was awesome. And look, Ray's a multi-billionaire and I'm not. So I'm not criticizing Ray Dalio. Genius, mad genius. But the problem was as rates went down, the trade wasn't working as well. And so what do? Oh, I'm an enterprising investment bank. I have a solution for you, Jack. Here's what you do. You lever. And we will provide that leverage through derivatives. No fee to you, no cost to you. And we'll take 4% out of this top, but you won't see it. And they sold these things. And, it's like the option writing, call, put writing strategies that all these people do. Look, being short volatility when volatility is going down, engineered by the Fed. Awesome. But it can work against you and it happens fast, right? My hashtag risk happens fast. And that's what happened. So I put a tweet out right before they made the announcement of the bailout. I think it was on Friday. Breaking, all caps, everything, ... And literally everything was breaking. And then they called the emergency meeting because it was an emergency. I mean, literally, it was an emergency. And to your point, the Bank of England basically said, yeah, this is a problem. If all of our pensions are defunct, literally, technically bankrupt, that would be a problem. So let's fix it. And so now you got this massive gaping alligator jaws. between the UK rates and GDP. And so you got this problem. And look, the lenders of last resort are called lenders of last resort for a reason. So I get it. Everyone thinks, right? The cult of Kelton has convinced everyone that you can borrow endlessly. The problem is the UK isn't the world reserve currency anymore. So the Bank of England can't do this. So they must be getting help from the Fed, because the Fed actually thinks they can do this.
Right, because if the British bond market, it is they are a sovereign currency. They can print as many pounds as they want, but those pounds will be devalued to dollars because there's more pounds. So yeah,
exactly, and that's why.
And that's exactly what happened. Yeah,
in 1913, the pound was 5, and now it's sub 1, and that's exactly what's happening. So
yeah,
look, unfortunately, I have to jump to another thing. I apologize for being late. This is great fun, and I don't think we'll push Mike to the side, although you and I are having some fun here.
Yeah, we are having some fun. Mike, he may stay on vacation. Who knows?
Yeah, he may stay in Morocco. He might not be allowed back in. Right? He may stay in the desert.
Mark, it's been a total pleasure. People should follow you on Twitter at Mark Yusko. You have 1 minute. In the 1 minute we have left, how bad do you think this earnings quarter that's about to come up will be?
Yeah, look, my personal opinion, I think it's going to be very bad. I mean, I really do. Will there be a lot of beats? Yes. Will that cause a lot of short squeezes? Yes. So you have to be careful, but I think it's actually going to be really bad. I mean, like bad. Like I think the airlines are going to be super bad, the cruise lines super bad, hotels super bad.
What about banks?
The chips. Oh, the banks. The banks might eke out some okayness because in crises, the volume of trading goes up and they take a spread. So, they may have skimmed enough off those derivatives to be okay. But I could see them getting hurt too with the rise in rates. So I think hold on to your hats. I think it's Uptober, right? The bull market socks for crypto and the orange pants. I think it's Uptober for digital assets. I think it's spooky, back to your original term, for equity markets.
Final question, is cash, do you agree with Ray Dalio, is cash no longer trash?
I never think cash is trash. I mean, I know his point, right? Which is after inflation, it's bad, but cash is an option. Right. And I like options. I like the ability to buy stuff when it goes on sale. Investing, only business. When things go on sale, people run out of the store. If you have cash, remember, conviction, courage, and cash. So I always like cash. Now, gold is probably better than cash in a recession. So you probably want a little gold more than cash. And I think Bitcoin, digital gold, even better.
Got it. Mark, thanks so much. Thank you, everyone, for watching. Have a great weekend.
Thanks.
Bye.